We use sales receipts for walk-in customers who pay on the spot. Thank you. Thank you. There's no need to have invoices for walk-in customers who pay on the spot. But one walk-in paid some in cash and the rest via credit card. How do I record that? We use QuickBooks Desktop. Okay, so first of all, I have to give you a kudos. And I know I say this a lot when I get a question, like, first of all, kudos, but I really mean it. You're recording cash in your business. Thank you. Not everybody does, everybody should, and I know I just use the S word, should. It's not a word that I use with some frequency, but there are consequences if you don't, and that's your indigestion to live with. So next up, you record, you track your cash. Good. I hope you're counting it every day, and not the same person who receives it and not the same person who records it in QuickBooks. Somebody else needs to count it. Anyhow, there are two ways to record it in QuickBooks when a walk-in customer who pays on the spot pays some by credit card and some in cash. The first method I'm going to give you is what I would call a best practice. It has its pros and cons, more pros than cons, hence best practice. And I'm going to give you a plan B, which has its advantages. Plan A, you use your sales receipt, you record the sale in the way that you normally do. However, you have a line item that's linked to your petty cash account or whatever cash account is in your general ledger that you use to record cash received from customers. The account type should be bank, and let's go with petty cash for the moment. You enter in that line item at the bottom of the sales receipt as a negative number because they already paid in cash. And so the balance due, so to speak, on the sales receipt is ultimately what they paid in plastic when they walked in, and you'll that should be classified as undeposited funds, and it'll chug through your merchant service processor and ultimately get into your company bank account, and you can use the features of QuickBooks to mirror that. That's option one. The advantage is one transaction in QuickBooks, and everything is pretty tidy. You can see at a glance what happened. They walked in, they ordered, negative number, they paid some, and they paid a credit card on the rest. And those are the items that really make it the best practice. Plan B is, I'll tell you why Plan B is needed. You don't really capture the payment method of cash. So if you do analysis in your QuickBooks file, which we frequently do for our clients, and part of what you track includes the payment method, using the best practice methodology that I just outlined, you're only going to get the payment method that you click off in those pretty little icons. Like you're going to check off, you can't check off two. So you're going to check off Visa or American Express or whatever credit card type that they use. And any kind of analysis that you do is going to show $50 came in through Visa. However, if it's really important to you to show the funds that came in by payment method, then Plan B is you're going to actually record an invoice. It seems ridiculous. Why would I have a receivable if they paid on the spot? Okay, let's make up that there was a microsecond in between when you handed over the goods and when they handed over the cash and plastic. In that microsecond, you're recording your invoice. If that's what you need to do to make those building blocks in your head make sense, then go for it. You're going to record an invoice, and fast as light, you're going to record two customer payments, one with cash and one with credit card, both applied to the same invoice. End of story. Plan A, Plan B, they have their pros and cons.